This video is neither a solicitation nor an offer to buy, sell stocks, options, futures, or any securities. The video and all contents are for educational and research purposes only. Please get the advice of a licensed financial advisor before investing your money in any financial instrument. Hello, swing traders. Okay, what we're looking at is the options window for Nucor. And right here on the left-hand side is what we're going to focus on, the calls. Now, options have an expiration date, and it's the third Friday of every month. And there's two main things. Options will expire, and there is time decay. What we're looking at is the March options, call options for Nucor. And here we have 41 days until expiration. And as time goes on, the options become less valuable. And basically, we have areas what's called in the money and out of the money. The gray area here is in the money because here we have a strike price of like $39 and $40. And let's look at the $40 strike price. The stock is at $40.46. So the strike price is $40. So therefore, it's trading higher than the strike price. So you are in the money. Now, out of the money is, let's say, a strike price of $41. Well, the stock is not trading at $41, so it's considered out of the money. So you have in the money, out of money, and your strike prices. Now, the higher the strike price, the less premium. As you can see here, the higher you go in your strike prices, 41, 42, 43, the less premium you will collect. Now, if you look right here, if you own 100 shares of Nucor, you can sell one call contract. And that's basically one contract is equivalent to like 100 shares. Okay, and that's why you see $1.96, because when you sell one, you collect $1.96 premium, which is equivalent to $196. Now, at expiration, the third Friday of March, let's say the stock closes at $40.99. Well, it's out of the money. So it's going to expire worthless. And you get to keep your 100 shares, and you get to collect the premium of the call, which is $1.96, which is equivalent to $196. Now, let's say the option expires, and let's say it's trading at $40, and you go ahead and your shares get called away from you. But the good thing is if you bought it at $40.46, well, you're selling your 100 shares at $41. So you get to keep the capital plus in dividends. And you get to collect the premium of $1.96, which is equivalent to $196. Now, a lot of traders like doing this type of strategy. They will buy 100 shares and go ahead and sell a covered call, and also it's called a buy rate because you're buying 100 shares and you're writing a call on it. They're called buy rates, they're called covered calls, and it's a good way to collect premium. And also, what I like doing is using these as targets, because if you're working all day and you bought a stock at $40, let's say you would be willing to sell it at $41. Well, if you go ahead and put a sell order in at $41, it hits $41, then you sell your 100 shares. Well, what I like doing is doing that, but also if the stock trending up or it's trending in a nice channel, and I purchase the stock and I do a covered call on it, why not collect the capital on it as well as some premium? So I like using it to to just get more capital and make more profit on a trade. So that's basically what a buy rate and a covered call is. You purchase 100 shares and you sell a contract on it, and you get to collect the capital. If it hits the strike price, you get to keep the capital plus the premium. And the good thing is let's say you purchased 100 shares and at the strike price of $42, and let's say you collect a buck 52. Now the good thing is, if it does not reach that strike price at expiration, well, the following Monday you keep your 100 shares and you get to collect the premium, and you can write another covered call on the shares that you own. Now you have to do these on 100 share increments. So if you own 1,000 shares, you can sell as many call contracts as you want. You can do like 1, 2, 3, 4, 5 contracts. Now 5 contracts would equal 500 shares. If you do 10 contracts, then that's 1,000 shares. And I like doing this, but I only like doing it on stocks that I believe in, stocks that I actually trade regularly, because I know how they react. And in the next video, I'm going to go over some of the more detailed profit potential, and also if the stock trades back downward, where your break-even point will be, because you can buy the stock at $40.46, sell a covered call, and if the stock trades back down, you get to collect the premium. Also, there is a break-even point, and that is something that you do need to be aware of. Is when you do these, you have to know where your profit and loss and where break-evens are. So we'll go ahead and close this out, and we'll do a part 3.